Time to talk funds now, and we're going to put the spotlight on trigger-based investing. You know, market triggers are often the reason for investors to get into or out of stocks. But can you apply the same strategy to mutual fund investments also? Dhirendra Kumar, CEO of Value Research, is here to tell us if it's a good idea for you to be trigger-happy when it comes to your mutual fund investments. Afternoon, Dhirendra, what is this trigger-based investing? How does it work, and is it useful to investors at all?
It could be useful in a very limited way for mutual fund investor. It is very useful for stocks. And the way it works is that investors decide before investing that on attainment of a certain value, or on achievement of a certain percentage gain, or attainment of an index level, a redemption will be triggered. So basically, investor gets his money back based on a predefined value judgment or value determination, and based on that he gets his money back. So it could be useful for somebody who is very goal oriented. You are doing a specific investment, and you think that if my 1 lakh rupee becomes 2.5 lakh rupee, your goal will be met for whatever need. It could be useful for that. Or if you are extremely apprehensive investor, if you are a very cautious investor, or you get very upset with a big decline, I think it could be more useful for investors who get upset that you put your stop losses in that sense, that my investment goes down in value by 15% and you will get your money back. So you reduce your pain, but this can translate into substantial opportunity losses for mutual fund investor, because what I understand is that stock investors are opportunistic investors, mutual fund investors are savers, and the very reason why one should be investing regularly in an equity fund is to accumulate through the market cycle, not necessarily run out of it.
Dhirendra, hi, afternoon. So, would you advise investors to go in for a strategy like this in the current volatile market timings?
In a limited way, yes. If investors are, if they have a limited time frame, and if they are doing any goal-oriented investment, and they can't really withstand a substantial loss in the interim, they should work on some framework whereby investment going down in value by over 15%, and something should be done about it. Or if it's a goal-oriented thing. Otherwise, most investors who are investing regularly, accumulating for their very long-term goals, for example, retirement or something, for financial security, which could be many, many years away, I think those investors should completely ignore the triggers.
Okay, long-term investors should ignore this. But Dhiren, for short-term investors, what kind of a corpus should they typically work with?
No, it's entirely a function of the scale of money needed for a defined goal. If you're planning to accumulate your savings for your car, or if you have a certain amount of investment, it should be based on that. I don't think a percentage of your it's not trying to allocate your money to a certain class of investment. It is basically a strategy which should be goal oriented and nothing beyond that. So it is a function of your down payment for a house, or your money accumulation for buying the next car. I think it should be something like that for that specific amount, not on your overall portfolio.